Swing Trading, Chapter 3, Building a Solid Charting Foundation. Trendlines are one of the simplest tools in charting, but they can tell you a lot when they are drawn correctly. At their core, trendlines help reduce the noise of individual candles and show the path price has been following. By connecting important turning points, they make it easier to see whether buyers are steadily pushing the market higher or sellers are steadily pressing it lower. This matters because swing traders are not trying to interpret every tiny move. They are trying to understand the underlying structure. A clean trend line can turn a messy-looking chart into a much clearer story. In that sense, trend lines do not predict price by themselves, but they do help you read who appears to be in control. The type of trend line you draw depends on the direction of the market. In an uptrend, you connect rising swing lows, because those lows show where buyers keep stepping in at higher prices. That line becomes a reference for support, meaning an area where demand has been showing up. In a downtrend, you do the opposite and connect falling swing highs, because those highs show where sellers continue to regain control. That line acts more like resistance, where rallies have been running into selling pressure. So the basic idea is simple. In rising markets, focus on the lows, and in falling markets, focus on the highs. Before you draw any trend line, make sure there is an actual trend to work with. If price is making higher highs and higher lows, you may be looking at an uptrend. If it is making lower highs and lower lows, that points to a downtrend. But if price is chopping sideways with no consistent structure, a trend line becomes much more subjective and much less useful. This is where many beginners go wrong. They want a tool to work, so they force it onto a chart that is not offering a clean trend. Grid charting starts with recognizing the environment first, then applying the tool only when it fits. Once you have identified a trend, the quality of your trend line depends on the swing points you choose. In an uptrend, you want to anchor the line to clear swing lows, not tiny wiggles inside a cluster of candles. In a downtrend, you want to use obvious swing highs for the same reason. The best anchors are points that stand out immediately, where price clearly changed direction and other traders would likely notice them too. Minor fluctuations often reflect noise rather than meaningful behavior. If you build a trend line from noise, the line may look precise, but it will usually have very little value. Clear turning points create cleaner lines, and cleaner lines usually lead to better decisions. A line becomes meaningful when price has actually respected it. 2 touch points are enough to draw a trend line, but a third touch makes it more credible because it shows the market reacted to that line again. You also want the line to fit the chart naturally. If it slices awkwardly through unrelated candles or only works when you ignore obvious price action, it is probably not a valid line. Think of a good trend line as something the chart reveals, not something you impose. The more cleanly price interacts with it, the more attention it deserves. That does not make it certain, but it does make it relevant. After connecting swing points, extend the trend line out to the right. That forward extension is what makes the line useful in real time, because it gives you a live reference for where price may react in the future. In an uptrend, it can help you monitor where pullbacks may find support. In a downtrend, it can show where rallies may run into resistance. This turns the trend line from a historical observation into a decision-making tool. You are no longer just saying where price turned before, you are watching where it might respond again. For swing traders, that forward-looking reference is often where the real value begins. A breakout happens when price moves through the trend line in the opposite direction of the existing trend. In an uptrend, the important signal is usually a close below the line rather than a quick wick through it. In a downtrend, you look for a close above the line. That difference matters because markets often poke through a line briefly and then snap back, which can trap impatient traders. A more decisive move, especially one that closes beyond the line, tends to carry more weight. Even then, it is smart to stay cautious and watch what happens immediately after the break. The goal is to recognize a meaningful change, not react to every small violation. A broken trend line is best treated as a warning sign, not a guarantee of reversal. It tells you that the prior behavior may be changing and that the side in control may be losing strength. Buyers may no longer be defending an uptrend as reliably, or sellers may no longer be capping a downtrend as effectively. But after a break, price can do several things. It might reverse, drift sideways, or recover and continue the original trend. That is why experienced traders avoid treating the break itself like a crystal ball. What it really does is shift the odds and signal that the old pattern deserves to be questioned. From there, follow-up price action matters more than the break alone. Let's make this more concrete with a simple example. Imagine a stock forms rising lows at 50, then 53, then later near 58 and 62. The first two lows allow you to draw an uptrend line, and the later touches give that line more credibility because price continues to respect it. Those repeated reactions suggest buyers are still stepping in along the same rising path. If price later closes at 61 and that close falls below the trend line, the message changes. It does not automatically mean the stock is collapsing, but it does suggest that support may be weakening. In practice, that would tell a swing trader to pay closer attention rather than assume the trend is still healthy. Most trendline mistakes come from trying too hard to make the tool fit. A common error is forcing a line onto choppy price action where no clean trend really exists. Another is treating every 2-point line as if it has already been confirmed, even though 2 points only make the line possible, not necessarily meaningful. Traders also get into trouble by reacting to every tiny break, even when the move is marginal and quickly reversed. Using minor noise instead of major swing points is another way to create false confidence. Clean trendline work is less about drawing more lines and more about being selective, patient, and honest about what the chart is actually showing. The best way to build confidence with trend lines is through repetition on wheel charts. Practice drawing an uptrend line using 2 rising lows and a downtrend line using 2 falling highs, then extend both lines forward. As price continues to unfold, notice whether a third touch confirms the line or whether the chart starts to break down. Also, pay attention to what counts as a real breakout versus a brief false move. This kind of practice trains your eye to separate clear structure from wishful thinking. Over time, you will start to see that strong trend lines usually look obvious in hindsight because they were already fairly obvious in real time. That skill becomes a foundation for everything else you do on a chart. Support and resistance answer one of the most practical questions in charting. Where is price likely to react? Support is an area where declines may slow down because buyers have stepped in there before. Resistance is an area where advances may stall because sellers have shown up there in the past. These levels matter because traders remember prior turning areas, and many orders tend to cluster around them again. The important idea is not that price must reverse there, but that those areas deserve attention. For a swing trader, support and resistance create a framework for planning instead of guessing. They help you think in terms of likely reaction zones rather than random movement. One of the most helpful habits in charting is to treat support and resistance as zones rather than exact numbers. On real charts, price often turns near an area instead of reversing at one perfect price level. That is why thinking of support as a floor and resistance as a ceiling is more realistic than drawing a razor-thin line and expecting precision. A reversal that happens slightly above support or slightly below resistance can still be a valid reaction. This keeps you from being too rigid in your analysis. Markets are not exact enough to reward that kind of false precision very often. The more you think in areas, the more naturally price behavior starts to make sense. Steady support and resistance are fixed price areas that do not move as time passes. You usually draw them horizontally across prior swing highs and swing lows where price has clearly reacted more than once. Repeated lows can define support because they show buyers repeatedly defending the same area. Repeated highs can define resistance because they show sellers repeatedly pushing back from the same zone. The more clean reactions you see at a level, the more meaningful it may become. These static levels are especially useful because they are easy to see and easy to plan around. They give your chart stable reference points that can remain important long after they first formed. Dynamic levels work differently because they move as price evolves. The most common example is a moving average, which rises, falls, or flattens depending on recent price behavior. In an uptrend, a rising moving average may act like support as price pulls back into it and buyers step in. In a downtrend, a falling moving average may act like resistance as rallies run into selling pressure near the line. Common choices such as the 20-period and 50-period averages are popular because many traders watch them. Unlike static levels, dynamic levels adjust over time, so they give you a moving reference instead of a fixed one. That makes them especially useful in trending markets where the important price area is not staying in one place. Static and dynamic levels are not competing tools. They are useful in different conditions. Static levels often stand out most clearly in range-bound markets where price keeps turning from similar horizontal areas. Dynamic levels often matter more in trends where support or resistance shifts as the market continues moving. The strongest setups often appear when both types line up in the same area. For example, a pullback into a horizontal support zone that also matches a rising moving average can attract extra attention. That overlap is often called confluence. Confluence does not guarantee success, but it can make a trade idea more structured and more convincing. A simple marking process can keep your charts useful instead of cluttered. Start by identifying the most obvious repeated turning points, not every tiny swing on the screen. Draw broad horizontal zones rather than thin exact lines, and ask how many times price has respected each area. If a level has produced several clear reactions, it probably deserves attention. Then add a common moving average such as the 20 period or 50 period to see whether dynamic support or resistance is lining up with those zones. The key is to focus on what stands out immediately. If you have to work hard to justify a level, it is usually not one of the important ones. A level matters because of the reaction it produces, not merely because price touched it. When price reaches support or resistance, look at how it behaves there. A sharp rejection can show strong opposition, while a tight cluster of small candles can show hesitation or a temporary balance between buyers and sellers. Repeated failure to push through a level often adds weight to that area. On the other hand, a strong close beyond the zone may signal that the level has finally given way. This approach keeps you focused on evidence instead of labels. Touches are common, but meaningful reactions are what make a level tradable. When price moves through an important level, the real question becomes whether the move is genuine. A breakout is when price pushes through resistance, and a breakdown is when price falls through support. But not every move through a level holds. False breaks can reverse quickly, which is why many traders wait to see what happens after the initial move. One of the most useful clues is the retest. If old resistance becomes new support and price holds there, the breakout often looks more credible. If price falls back through the level immediately, caution is warranted. Retests do not always happen, but when they do, they often help separate conviction from noise. Support and resistance become especially powerful when you use them to structure a trade plan. An entry might come near confirmed support if price shows signs of holding that area. A target often makes sense near the next resistance zone, where price may begin to struggle. A stop usually belongs beyond the key level, in the place where the trade idea would clearly be wrong. Retests can also offer more controlled entries because they let you act after price has proven the level matters. This is why charting is not just about description, it is about decision-making. Levels help turn a vague idea into a plan, with logical entry, risk, and reward points. Consider the ABC Corp example. If prices bounce several times near 45, that area begins to stand out as static support. If rallies repeatedly stall near 55, that creates static resistance. If a rising 50-day moving average keeps supporting pullbacks in between, you also have dynamic support working with the broader structure. A close above 55 would suggest a breakout from that range, but the more convincing version is often the one that later retests 55 and holds above it. In that case, the chart is showing static support, static resistance, and a dynamic guide all working together. That kind of alignment can give a swing trader a much clearer framework for action. The most common support and resistance mistakes usually come from being too early or too rigid. Drawing too many levels clutters the chart and makes everything seem important, which means nothing really stands out. Treating levels as exact numbers can also be misleading, because real reactions often happen within zones. In trending markets, ignoring moving averages can cause you to miss important dynamic support or resistance. Traders also get trapped by acting on the first apparent break, without waiting for follow-through or a retest. A cleaner process helps mark only the important areas, think in zones, and let the reaction confirm whether the level truly matters. Candlesticks give you a compact way to read the struggle between buyers and sellers during a single period of time. Every candle shows four pieces of information: the open, the high, the low, and the close. The real body compares the open and close, while the wicks show where price moved but could not hold. A large body often suggests conviction because one side was able to push price strongly by the close. Long wicks, by contrast, often suggest rejection because price was pushed back before the period ended. This makes candlesticks useful not because one candle predicts everything, but because each one reveals how that battle unfolded. For swing traders, that can add important detail to the larger chart structure you have already identified. Among all candlestick patterns, three are especially worth knowing early on: engulfing patterns, dojis, and pin bars. Engulfing patterns can signal a sharp shift in control from one side of the market to the other. Dojis often show hesitation, balance, or a pause after a strong move. Pin bars highlight rejection, where price was pushed hard in one direction and then snapped back before the close. But context matters more than memorization. The same pattern can be meaningful at a key support or resistance area and almost useless in the middle of random noise, so the goal is not just to spot shapes. It is to understand when those shapes are appearing in places that matter. An engulfing pattern uses two candles and suggests a strong change in short-term control. In a bullish engulfing pattern, a small bearish candle is followed by a larger bullish candle whose body fully covers the body of the first candle. That tells you buyers did more than just recover. They completely overwhelmed the prior candle's body. A bearish engulfing pattern works in reverse, with a small bullish candle followed by a larger bearish candle that fully covers the first body. The key rule is that the second real body must engulf the first real body. Wicks are less important here than the bodies themselves. The message is that momentum shifted sharply from one candle to the next. A doji is a single candle with a very small real body, which means the open and close finished at nearly the same level. That small body suggests neither buyers nor sellers clearly won by the close. The wicks can be long or short, and those variations may add detail, but the central idea is indecision or balance. After a strong directional move, a doji can hint that momentum is fading and the market is pausing. In a sideways market, though, dojis are common and often unimportant because indecision is already the normal condition. So a doji is not a reversal signal by itself. It becomes useful only when its location and the next candle give it meaning. A pin bar is a rejection candle. It has a small body, one clearly long wick, and the body sits near the opposite end of the candle from that long wick. A long upper wick can show that price pushed higher, ran into resistance, and was forced back down before the close. A long lower wick can show that price dropped into support and then bounced strongly before the period ended. The longer and cleaner the rejection wick, the more meaningful the pattern tends to be. Many traders like to see a wick that is at least about twice the size of the body. At its heart, a pin bar tells you that one side tried to take control and failed. Candlestick patterns become much more useful when they appear at meaningful locations on the chart. A pattern forming at support matters more because that is an area where buyers have shown up before. A pattern forming at resistance matters more because that is where sellers have previously stepped in. The same engulfing candle or pin bar appearing in the middle of a messy range often carries much less weight. This is why traders say location first, pattern second. Nearby structures such as a swing point, a trend line, or a moving average can strengthen the message even more. The pattern is the clue, but the location is what gives the clue importance. A consistent review process helps you avoid forcing patterns onto the chart. Start by asking whether there was a clear prior move, because reversal style patterns mean more after an actual push up or down. Then identify the candle pattern strictly by its definition instead of giving yourself credit for something that is only close. After that, check the location. Did it form near support, resistance, or another meaningful swing point? Finally, wait for the next candle to confirm the idea. This same sequence keeps your analysis disciplined. It helps you judge patterns by evidence rather than by excitement. Confirmation is what helps turn a pattern from an observation into a more credible signal. After a bullish engulfing pattern, you often want to see higher follow-through or at least support above the engulfing candle's midpoint. After a bearish doji at resistance, a lower close on the next candle helps confirm that sellers are beginning to take over. After a bullish pin bar at support, you want to see price lift away from the rejected low rather than drift back into it immediately. If that next step confirmation never arrives, the pattern may simply be noise. This is a critical habit because many weak setups look interesting for one candle. Confirmation helps you avoid acting too early. Take a simple example of a doji at resistance. Suppose price rises from 215 to 245 over 3 trading days, showing strong upside momentum into a known resistance area. At 245, a doji forms with a tiny real body, signaling hesitation right where sellers might be expected to respond. By itself, that is only a clue. If the next candle opens around 244.90 and then closes lower at 242.50, that lower close provides bearish follow-through. The sequence is what matters. First a trend, then a pattern, then the right location, and finally confirmation. That full chain is far more useful than a doji appearing by itself in the middle of nowhere. Not every candle pattern deserves your attention. The strongest setups usually have several pieces lined up at once. A clear trend or prior move, a well-formed pattern, a meaningful location, and confirmation afterward. Weak pin bars with no dominant wick are easy to overrate, and partial body coverage should not be labeled as a true engulfing pattern. Patterns that appear inside noisy ranges are also often less reliable because the surrounding structure is unclear. In practice, this means you should be comfortable passing on many setups. Good trading often comes from selectivity. If the evidence is only halfway there, it is usually better to let it go. The goal with candlestick work is to build recognition without feeling the need to trade every pattern you see. A useful exercise is to find one clear doji and one clear pin bar on a 1-hour chart. Then review the same 4 questions each time. What was the prior trend? Where did the pattern form? Was the pattern quality strong? And did the next candle confirm it? Also make sure support or resistance is based on at least 2 prior touches, not something invented after the fact. This kind of practice builds judgment much faster than random memorization. Over time, you begin to see patterns as clues within context rather than as automatic signals. That is the habit that makes candlestick reading genuinely useful. A chart time frame tells you how much time each candle represents. On a 15-minute chart, each candle captures 15 minutes of trading activity. On a 1-hour chart, each candle represents 1 hour. And on a daily chart, each candle represents 1 full trading day. The market itself has not changed, but your view of it changes depending on the time frame you choose. Shorter time frames show more detail and more noise, while longer time frames smooth things out and reveal the broader path. This is why the same stock can look chaotic on one chart and orderly on another. Understanding time frame is the first step toward choosing a chart that actually fits the trade you want to make. The chart you analyze should match how long you expect to hold the trade. If you are planning a trade that may last for days or weeks, very short intraday charts can distract you with noise that does not matter to your idea. If you are taking a trade meant to last only minutes, a daily chart may be too broad to help with timing. Shorter time frames give you more detail, while longer time frames give you more context. Neither is better in an absolute sense. The point is alignment. When your chart matches your holding period, your decisions tend to become more consistent and less reactive. A helpful way to think about time frames is to compare them to different kinds of maps. A short time frame is like a street level map. It shows fine detail and can help you with precise timing. A long time frame is like a regional map. It gives you the broader route and overall direction. If you only use the street level view, you may lose sight of where you are going. If you only use the regional view, you may miss the turn right in front of you. Good analysis usually needs both perspective and precision. For swing traders, that means balancing detail for entries with enough context to understand the larger trend. Timeframes are often grouped by the kind of trade they support. Very short-term charts, such as 1 minute, 5 minute, and 15 minute, are commonly used for trades lasting minutes to a few hours. Medium-term charts, such as the 1 hour, 4 hour, and daily, are often more useful for trades lasting hours to several days. Weekly and monthly charts are usually better suited to ideas that may last weeks or even longer. These are not rigid rules, but they are practical starting points. The benefit of thinking this way is that it keeps your chart selection tied to trade duration. That alone can prevent a lot of confusion and overanalysis. A strong habit is to decide your expected hold time before you choose your chart. Ask yourself whether this is a trade you expect to hold for minutes, hours, days, or weeks. Once that is clear, choose the main time frame that best matches that plan. That main chart becomes the one you use to judge the setup and manage the trade. This sequence matters because it keeps your analysis connected to the trade idea instead of random browsing. When traders flip through charts first and decide later, they often end up forcing a trade to match whatever they happen to see. Duration first, chart second is a much cleaner process. One chart is usually not enough, but you also do not need a dozen of them. A simple approach is to use one main time frame, one higher time frame, and one lower time frame. The higher time frame gives you broader context and helps answer what the larger trend is doing. The main time frame is where your actual setup lives and where most of your trade decisions are made. The lower time frame helps refine entry timing if you want more precision. This 3 time frame structure is often enough to stay organized without becoming overwhelmed. It gives each chart a job, which helps prevent random chart hopping. Multiple time frame analysis works best when each time frame answers a different question. The higher time frame should tell you the bigger trend and overall market context. The main time frame should show you whether a usable setup is actually forming. The lower time frame should help you decide when the timing is favorable enough to act. When all 3 are answering their own question, the analysis becomes much more organized. You are not looking at multiple charts just to collect more opinions. You are using them to build a complete view from direction to setup to execution. Imagine you are planning a swing trade that you expect to hold for about 2 days. A daily chart can give you the broad context and show whether the bigger trend is rising or falling. A 4-hour chart might then serve as your main decision chart, where you evaluate whether the setup still looks intact. A 1-hour chart can help you spot a pullback and bounce for a more precise entry. In that arrangement, each chart supports the same trade idea at a different level of detail. When the daily trend, the 4-hour setup, and the 1-hour timing all point in the same direction, the idea usually becomes clearer. That alignment does not remove risk, but it often improves structure. The strongest trade ideas often tell the same story across time frames. If the higher time frame is trending up, the main time frame is forming a bullish setup, and the lower time frame offers a clean entry. The pieces are working together. That kind of agreement usually gives the trade more context and more clarity. When the charts conflict, the situation changes. For example, if the higher time frame is strongly down but the main chart is tempting you into a long trade, you are working against the larger picture. Counter trend trades can still happen, but they usually require more caution and tighter judgment. Alignment is not about perfection, it is about reducing unnecessary conflict. Time frame mistakes usually come from either too little context or too much chart switching. Using only one time frame can leave you blind to the bigger trend or to the finer entry details. Mismatching the chart with the expected hold duration can create bad decisions, such as managing a multi-day trade off a noisy 5-minute chart. Ignoring the higher time frame is another common problem because it removes valuable context. On the other side, using too many time frames often creates confusion rather than insight, and constantly switching charts until one justifies the trade is a form of confirmation bias. A simple, consistent structure helps avoid all of these traps. A good way to practice time frame alignment is to turn it into a short checklist. Write down your realistic holding period first, then choose a main time frame that fits it. After that, look one time frame higher to understand the broader trend and one time frame lower to judge entry quality. Finally, ask yourself a simple question. Does this chart view actually fit the trade I want to make? If the answer is no, adjust the time frame before you adjust the trade idea. This habit keeps your analysis grounded in purpose. Over time, it helps you choose charts that support the trade instead of distracting from it. A simple moving average, or SMA, gives you a moving reference point rather than a fixed horizontal level. It is calculated from recent closing prices and updates as each new bar forms, so it changes with the market. That makes it useful for following the path of a trend instead of anchoring your analysis to one static price. In an uptrend, an SMA can behave like a moving floor where pullbacks may find support. In a downtrend, it can act more like a moving ceiling where rallies may struggle. This is why many traders watch SMAs closely. They help translate recent price behavior into a line that can guide structure and context. What matters most with an SMA is not the line by itself, but how price reacts around it. When price is above the SMA, a pullback into the line may attract buyers and act like dynamic support. When price is below the SMA, a rally up into the line may meet sellers and act like dynamic resistance. In both cases, the line is only useful because traders are watching whether buying or selling pressure appears there. That means contact alone is not enough. You want to see evidence of response, such as a bounce, a stall, or a rejection. The SMA gives you the area to watch, but price behavior tells you whether it matters. Different SMA lengths behave differently, and some attract more attention than others. Shorter SMAs, like the 10 period and 20 period, respond quickly to price and are often useful for shorter swings. Because they react faster, they also produce more noise and more false breaks. Longer SMAs, such as the 50 period and 200 period, smooth out more noise and often matter more because so many traders watch them. They respond more slowly, but their reactions can carry more significance. So there is always a trade-off between speed and stability. The key is to choose the average that fits the kind of price movement you're trying to track. The same SMA number does not mean the same thing on every chart, which is why time frame matters. A 20-day SMA on a daily chart reflects roughly 1 month of trading and can be useful for shorter swings. A 50-day SMA often tracks an intermediate trend on that same daily chart, but a 200 period average on a 5-minute chart means something very different from a 200-day average on a daily chart. That is why you should match the SMA length to both your time frame and your expected hold period. Faster swings often use faster SMAs, while longer holds often rely on slower ones. The number alone is not the point. The context around it is. A touch of the SMA is only the beginning of the analysis. First, plot the moving average on your chart and pay attention to how price approaches it. Does price come into the line gradually, or does it slam into it with momentum? Once it gets there, look for the kind of reaction that follows. A rebound can suggest support or resistance is still working. A stall can suggest hesitation, and a sharp reversal can show a stronger response. One touch by itself does not prove the line is important. Repeated reactions and recognizable behavior are what make the SMA worth using. An SMA becomes much more useful when other evidence supports the same idea. In an uptrend, a rising SMA is stronger when you also see bullish candles forming near it. In the downtrend, a falling SMA means more when rallies into it are met with bearish candles or repeated rejection. It also helps when the SMA lines up with a horizontal price level or a trend line, because that creates confluence. Repeated reactions at the same moving average can further strengthen its relevance. This is why experienced traders rarely treat an SMA as a trade trigger by itself. It is better used as context that becomes actionable only when other clues agree. When price breaks decisively through an SMA, the line may stop behaving the way it did before. A clean close through the moving average can signal that the prior support or resistance has failed. If the break happens with strong momentum, it often deserves even more attention. But just like with horizontal levels, follow-through matters. The next bar or session can help confirm whether the break is real. Often, a line that had been acting as support will later act as resistance when price retests it from below. Watching that role change can help you recognize when trend conditions are weakening or shifting. Consider a rising 50-day SMA in an uptrend. If price pulls back to that average and bounces from it 3 separate times, the market is showing you that the line is acting as dynamic support. Those repeated reactions make the 50-day average more meaningful than a wine price has barely noticed. But if price later closes below the SMA, the interpretation changes. That break suggests support may have failed, at least for now. If price then retests the same SMA from below and gets rejected, the line may have shifted from support into resistance. For a swing trader, that can mean reducing bullish exposure, waiting for better evidence, or avoiding new longs until price proves it can recover. A practical way to study SMAs is to compare 2 of them on the same chart. Add a 20-period SMA and a 50-period SMA, then mark the first 3 touches of each line. At every touch, ask what price actually did. Did it bounce cleanly, chop around the area, or break through without much respect? This comparison teaches you to focus on reaction quality instead of simply counting touches. It also helps you see which average the market appears to care about more in that specific trend. From there, you can write a simple trade idea for the next touch, including what kind of confirmation you would want before acting. Moving averages are helpful, but they are easy to misuse. One common mistake is cluttering the chart with too many SMAs, which makes it harder to see what really matters. Another is ignoring the slope of the average. A rising SMA, a falling SMA, and a flat SMA do not carry the same message. Traders also get into trouble by treating every touch like a signal, even when price shows no meaningful reaction there. And it is important to remember that even widely watched SMAs can fail. The best approach is to keep the chart simple, watch how price behaves, and use the SMA as context rather than as an automatic answer.